Hey guys, in today's video, I'm going to cover off 5 lithium stocks that are worth a look at. Okay, the first one, guys, and just to note, I am going to be using simply Wall Street to analyze this. One downside is that obviously a lot of these companies are reliant on mining licenses or mining projects becoming viable or approved, and therefore not all of this will be great, but it is a really good starting point, and it also highlights to you, I guess, just how difficult it will be for some of the projects to get on board, just because they might be burning through cash. They don't have great growth from analysts. And the nice thing though is that by using this tool, it actually shows us how many analysts. So for example, on the first stock I'm going to cover, Pilbara Mineral Resources, ASX ticker PLS, it shows me the analysts. 9 analysts cover it, and 5 of them have been used, like their numbers, actual analysts who are in the industry's numbers have been used to compile this. So that is the one benefit. Let's get into it, guys. So the first one is Pilbara Minerals, and I've kind of tried to do this from largest to smallest. Probably you would argue, least risky to most risky. That doesn't mean that there's obviously no risk, because all of these have risk, and you've seen it. Whenever the price of lithium changes, these are affected in a big way. So Pilbara Minerals is the biggest one that I'm covering off. It's currently trading at $3.20, has a market cap of 9.5 billion. It's up 6.7% in the last 7 days and 213.7% in the last year. So Pilbara Mineral Resources Limited explores for and develops and operates mineral resources in Australia. If you want more information on that company, obviously you can click this link. So basically this gives you a little bit of a snowflake analysis based on these factors here. And in the analysis is exceptional growth potential with excellent balance sheet. So earnings are forecast to grow 20.85% per year. And it's became profitable this year too, which it gets a little tick for. Risk analysis, there were some large one-off items. We'll cover all this further down. And shareholders have been diluted in the past year. That's the other factor to watch with these. If shareholders are continuously being diluted, it actually is really hard for performance eventually to catch up. And you may get a huge spike followed by a big period of sideways action if this happens. I'm not saying it will with these, but it's just something to take a note of. What's nice here is it does give you some competitors. They're not direct competitors, they're just in the mining space, to be honest. If we look at the last 1 month, had a good run. 3 months, it's actually down from its high. 1 year, if we look at the year, it's had a very good run from $1. We're up $3.20, as high as $3.86. 3 years, phenomenal. It was in the 30 cents and 70 cents back here. 5 year, 14 cents to hit to the $3, well over $3, almost $4 mark is amazing. And if we go back even further, we're talking about 0.008 of a dollar. I like this as well because it gives you some analyst expectations, and the price target from analysts has been raised to 346 by one of them. And a non-executive director just bought $103,000 earlier in March of stock. So first half earnings, I just quickly read this. It just gives me a top level view of how PLS is going. First half 2022 earnings, EPS exceeds analyst expectations while revenues lag behind, right? Ken Brinsden has stepped down as CEO, all things just to take into account. So it's outperformed AU Minerals and Mining well and truly, and also for the 7-day and 1 year period as well. It's exceeded, as I just said, which returned 18.8%. Returns versus market, PLS exceeded the Australian share market, which returned 8%. Stable share. PLS is not significantly more volatile than the rest of the Australian stocks over the past 3 months, typically moving plus or minus 8% in a week, which you would assume is actually quite a lot. But PLS weekly volatility 8% has been stable over the year. Right. The industry, though, I guess it's what it's comparing it to as well, is quite high. So PLS is less volatile than the average market volatility and the industry. So founded in 2005, 300 employees, Pilbara Mineral Resources Limited explores for, develops and operates mineral resources in Australia. The company holds a 100% interest in the Pilbara Lithium Tantalum project located in the Pilbara region of Western Australia. The company was incorporated in 2005 and headquartered in Perth. So obviously still early days, PE ratio of 113.8. So it had 83 million 83.7 million in earnings, and revenue was $408 million, $9 billion market cap. So that's what I'm telling you, 9.53 billion, and it made $83 million. Obviously, what we're assuming is growth is going to be high in this stock, and a very, very high price to sales ratio of 23.3 times. Again, we can kind of see here, we show the cost of revenue is 231 million, gross profit 177, other expenses 93, so we're left with 83 million. Earnings per share of 0.028. Nice, healthy gross margin of 43.41, net margin of 20.49, debt to equity ratio of 20.4%. So it doesn't score very well on the valuation side, because obviously this is still somewhat of a growth stock, but at $9.5 billion valuation, you know, how much more upside does this have? Not sure. And that's why people then tend to look at, I guess, the smaller end of the market. But at $9.5 billion, maybe this one day could become a 20, 30, $40 billion company. It's well within the scope of possibility, but on valuation front, it's obviously very, very, very expensive. And according to Simply Wall Street, is far above its fair value. Again, if we're expecting future growth, this isn't accounting for it, and this is just a guideline, right? So below fair value according to this. Again, if earnings grow well, everything goes well, then this may not matter at all. Poor value compared to the Australian metals and mining average, which is smaller companies not growing larger companies not growing, 12.6%. It's poor value compared to 17.7% of the, which is the Australian market PE ratio. On a PEG, it's expensive again as well. Price to book, it's 11.3 times. But here we go. On future growth, ticks everything according to them. So forecasted annual earnings growth of 20.9%. You do that for a few years, and that PE starts to come down very, very quickly. As you can see, so this is the current year where we've just said 408 million and 83 million in earnings. That goes out to 1 billion in revenue and 592 in earnings. And then by 2023, analysts are assuming it's going to have over 1.1 billion in earnings. So that's significantly higher, more than 10 times higher, the current earnings, right? So if that happens, then the current PE is almost irrelevant, right? So analysts' future growth forecast 20.9%. for earnings, and then annual revenue growth of 23.4% is what analysts are assuming. So PLS forecast earnings growth of 20.9% is above the savings rate of 1.8. And as you can see, everything else has had a bit of a tick here. Earnings growth, they're assuming very, very high in quick earnings growth here. Future return on equity is said to be very high in 3 years' time, 41.1%, which is far higher than the industry average. Past performance, so 4% annual earnings growth, but this was the first year to actually profitable. And if we look here, you can see how it's gone from unprofitable to profitable. Past earnings, again, not really worth looking at. It's just become profitable. Let's hope we still have a strong lithium price and this continues to do well. So we've kind of looked at all these. Financial health, let's look at the balance sheet and the rest of it. So it's ticked most things. The only thing it has suffering from is it isn't reducing debt, which makes sense if they're in a growth phase. But it does have $312 million in short-term assets and 153 in liabilities. And again, long-term exceeds long-term liabilities. So long-term assets exceeds long-term liabilities, again, which is what we want to see. Debt to equity, history and analysis. PLS has more cash than its total debt. It's not reducing debt. Debt coverage, it's well covered by operating cash flow, 75.5%. And interest payments are well covered by EBIT, which is all good. Obviously, it doesn't currently pay a dividend, but it does have a forecasted dividend, still on the small side. Let's look at management now. 5.7 years is the average management tenure, with some people, the CEO at 6.17 years, $2.2 million in compensation. The CEO's compensation is below for companies of similar size in the Australian market, not a bad thing. And then if you want to do a bit more digging, look at the actual leadership team. Board average tenure is 5.4 years. So ownership, this gives us a bit of information when people are buying and selling. It seems fairly balanced here. Insiders have bought more in the past 3 months than they've sold, as you can see, which is good. And then it gives us some transactions. Obviously, we want to see people buying and not selling. Ideally, there will be some selling, especially when companies are growing quickly. So general public owns 57.4%, 25% by institutions, and then the rest by public companies and the rest, individuals. But as you can see, just cut this bit out, sorry Alex. But here's one thing, shareholders have been diluted in the past year with total shares outstanding growing by not much, 2.8%, that's fine. Top 25 shareholders own 41% of the company. And that is all for PLS. Let's move on to AVZ Minerals, currently trading at $1.19, $4.1 billion market cap, up 17%, almost 18% for the 7 days, and almost 500% for the year. Explores for mineral properties. It's trading 68.1% below our estimate of fair value. Earnings are forecasted to growth by 97.87% per year. It does make less than USD 1 million in revenue. Volatile share price over the last 3 months. Significant insider selling, and shareholders have been diluted. So flawless balance sheet with moderate growth potential. I would say that probably not the case, because obviously the growth potential is very, very high. It is a smaller business with potential to grow much, much faster. Here are some competitors if you're interested in looking at more of them. Price history, very, very similar. You know, in the last year, we've gone from 18 cents all the way to $1.20. 3 years, very, very similar. Had a big flat period. And this actually shows you some events that have occurred as well. So forecast to break even in 2024, which is interesting. I definitely, if you are looking at this stock, dig deeper into this. A director recently did sell $651,000 worth of shares. I'd want to know why. So shareholder returns, we've kind of already covered, well above the industry average. Not really much point in looking at this. Price to sales of 4,555 times. P ratio negative. It's not making any money. It's obviously spending money. 12 million, negative 11.8 million in earnings. Valuation, again, below fair value, significantly below fair value, but on other metrics looks expensive. Don't know how much to put into this though, guys. Like, that's not to say that that will happen. These things get very skewed in early stage projects. Not that this is super early, but it is definitely still early. So price to earnings ratio is still negative. Price to earnings growth ratio is not available. Let's skip past this and go to future growth. So future growth is meant to be 97.9%, which is great. And as you can see, so we're looking at June 30, 2024 at being at $337 million. So this is like 2 to 3 years before PLS, maybe even a little bit before, right? 2024 is kind of where PLS would be now in terms of the earnings numbers. So it is forecasted to grow very, very fast if everything goes to plan. As you can see, again, it's 2024. So all this, you're going to have to hold it for quite some time, right? A lot can happen between now and 2024. There we go. Let's skip to financial health. Everything seems to be doing well. $77 million in assets, small amount of liabilities in the short term, and again, long term, the same deal, far exceeds it. Debt to equity history analysis, it's debt free, has not had any bad debt in 5 years. Stable cash runway, has sufficient cash for more than a year, has sufficient cash for 1.1 years if cash flow continues to reduce at historical rates. No dividend. Let's quickly look at management. 3.4 years, obviously smaller, earlier stage company than the previous. So 3.4 years, CEO has been there for 4 years, $637,000 for their compensation. So insiders have only sold shares in the last few months, but if you look at it at 6 to 9, it almost nets out. Almost, or not quite, because whoever bought here did very, very well. So that might have been a signal 6 to 9 months ago that it was very, very cheap, and now someone might be selling to, I guess, make a profit. Who knows? You'd have to do a bit more digging, but that is the breakdown. General public owns the most, which sometimes when general public owns this larger chunk, it can make it quite volatile, and the shares have been diluted in the past by growing by 19.4%, which is a lot more than the previous. So definitely one to keep an eye on. Let's move on to Liontown Resources, ASX ticker LTR, was trading at $1.83. It's a $4 billion market cap. It was actually down 1.6 for the last 7 days and up 306.7% for the year. Again, we already know what they do. Became profitable this year. Earnings are forecast to decline by an average of 43.4% over the next 3 years. It does make less than USD 1 million in revenue, so that doesn't really make sense about the profitability. I would have to look at this more. Flawless balance sheet with acceptable track record. Some competitors here. A lot more of sideways action on this one since September. Let's look at the 3-year period. So it really spiked in October 2020, and then again in mid to late 2021, and massively towards the end. Went down, back up now. So price target lifted to $2.52 by 3 analysts here, which is a good sign. No longer forecast to break even, though I'm not sure what's happening there. I'd have to look at it in a bit more detail. So price volatility, LTR is not significantly more volatile than the rest of Australian stocks, typically moving 12% in a week, which doesn't really make sense. I would imagine that they would be far more volatile. Has been stable at the same level of variance over time. So they engage in exploration and evaluation of mineral properties in Australia. The company explores for gold, lithium, gold, vanadium, copper and nickel deposits, as well as platinum group elements. So earnings of 42.5 million. Go. Valuation, let's not even look at that. Let's skip through because these metrics are not really relevant. Future earnings growth, revenue growth is meant to be 134% growth. Everything else looks red. Again, early stages. Problem here is we're not quite forecasting any amount of growth in the next few years, so you'd be looking at this far longer term. This is why this is good to look at, because this is kind of telling you what analysts are expecting. They're not always right, but it's just giving you an idea. Revenue is obviously meant to grow. Well, it did at the end of 2021. Past earnings growth analysis. LTR has become profitable over the last 5 years. I'm not sure where this figure is coming in, whether there was some kind of capital raise, something, but I'm just trying to cover off all the common stocks that people have been mentioning in this space. Assets of $461.76 million, which exceeds the liabilities, which is good to see. Debt to equity, debt-free, no debt in the last 5 years. Strong operating cash flow, no debt. All good to see. No dividend. Let's look at the management team. Management hasn't been there long, 1.8 years, with only 0.8 years for Tony. His pay packet is very high when you compare it to AVZ, though, at almost 2 million. He's getting paid the same as like PLS. I think that could be a bit of a red flag. You'd have to look at more as to why. It seems like a very big pay packet for someone, unless they're very experienced or something like that. They're saying it's well below, but maybe in size, but potentially just the stocks had too big of a run. Not sure yet. Have to do more digging. 1.8 years, 7.7 years for the board, which is great. So it means that the board is more experienced, so that's good to see. Ownership seems insufficient data, so there's not enough information. So we've had 2 sales here, 1 sold and 1 bought. Ownership breakdown, again, individual insiders own 20%, which is nice. Public owns 67%, institutions 8.3%. So these don't become these are very volatile until institutions take up a larger chunk. That's what you'll see. You'll see a lot more volatility and a lot more dilution here. So 20.8% dilution. Here are the top holders and some more information about the company. Now, moving on to Core Lithium, ASX ticker CXO. It's trading at $1.22, $2.1 billion market cap, down 0.8% in the last 7 days, up 478% in the last year. So they engage in exploration and development of lithium and various metal deposits in Northern Territory and South Australia. Earnings are forecasted to grow at 119%. Looks like there is 2 analysts covering this off, which is where the data came from for this. Makes less than USD 1 million in revenue. Volatile share price growth for the past 3 months. Shareholders have been diluted in the last year. Competitors, similar run. You know, lithium has been on an absolute belter, and it just seems to slowly be kind of just petering up here. Whether or not it goes down, goes sideways, goes up, we don't know yet. We just know that the demand for lithium is there well into the future. This has gone from 23 cents in the last year all the way up to $1.25 almost, 24. 3 years, even bigger growth. And obviously you go further out, the same thing. So it looks like it's provided an exploration update on the 11th. Definitely worth a look at. It's more volatile than 75% of Australian stocks in the last 3 months, moving 13% in a given week. Obviously very, very volatile holding these here. Let's skip through these. Let's go to future growth. It's expecting to grow at 119%. So we're kind of looking at 2023 being the year that they start to make revenue, make money, and 2024 really when they really get running. Let's skip past this bit. There's no point. Let's look at financial health. All looks good. Short-term assets exceed short-term liabilities, and same with the long-term. Debt-free, not had any debt in the last 5 years. Sufficient cash runway, great. No dividend, all good. Management has been here for longer, which is great, 4.6 years, and compensation is $361,000. Been there 11.5 years, so this is a good sign. I do like to see that. It's below average, consistent. So hopefully they're getting more, I guess, in terms of actual stock and options and things like that. 4.6 year average tenure, 9.5 years for the board, very experienced board. There has been insider selling, but there's only one sale there, so it's not enough to show you anything. The general public holds such a large chunk, 82.8%, which is probably why it is very volatile. And let's move on to the next one, and the last one, ASX ticker VUL, so Vulcan Energy Resources, $9.75, market cap of 1.3 billion, 4.7% down in the last 7 days, 64.7% up in the last year. So it engages in geothermal energy and exploration activities in Europe. Revenue forecast to grow at 67.11% per year. Risk analysis, currently unprofitable and not forecast to become profitable over the next 3 years. Shareholders have been diluted, does not have meaningful revenue. As you can see, the last year's been a bumpy ride. Got as high as $15.90 and it's pulled back to $9. It's kind of trading towards the lower end, and it has been as low as $6. We look at 3 years though, absolute belter. You're talking from 16 cents all the way up to, it's 100x. 5 years, even more. Like, this has had a phenomenal run, but the price target just keeps getting reduced, which means that this may have lost some favor in this stock at the moment. And it does. It takes a long time for information to come out about these businesses. So just keep an eye on it and you might be able to pick it up if there is a pullback. Even more so, don't be surprised if it does keep dropping. It's not significantly more volatile, moves 9% in a given week. Again, let's skip over and go to future growth. 26.8% growth. No real, the next few years doesn't seem like anything meaningful. Revenue is only starting to kind of get going in 2024, so potentially even further ahead. These, again, this is very, very, very early stage, guys. I can do a bit of a deep dive into this and actually look at some of the actual updates and stuff like that and just give you a bit more information. Just trying to show you what's available in this tool and see if you enjoy going through it. Financial health looks good. Short-term liabilities, assets exceed liabilities on both short and long term. Has more cash than debt. Cash runway has enough cash, great. Does not pay a dividend. Let's look at the management team. 1 year tenure is the average, 2.5 for the CEO, 228,000 euros. Compensation in line. Board members, everyone's kind of been there not very long. Definitely more selling, but there's more frequent small chunks of it being bought. That is a big sale here. I'd want to look at why Gavin sold $7.5 million of shares. Again, see, individual insiders own a nice chunk. General public owns a lot of this, but it is more private companies and insiders and institutions and stuff are kind of getting into the space. And yeah, I hope you've enjoyed this video, guys. Please let me know if you like this format. I know it's quick, but I'm just trying to give you a really big overview of these stocks. They're quite popular, and just to give you a bit more information and something to go off. Thanks so much, and see you in the next one.